Second. Right, bear with me a sec. Just opening my slides here, bear with me. Yeah, here we go. Right.
Sorry for a relative low attendance today because this is rescheduled. I'm not sure everyone have received the notification, but like people are constantly joining now. It's more than 10 people now. Yeah, sorry about that.
That's okay. Can you see the screen?
Nope, not yet.
No. Okay. I think we've lost our connection there. Right. Let me try again. Here we go. Right. We'll share that screen. Okay.
Yeah, it shows you have started, but there's no image.
Yeah, screen sharing has stopped. Bear with me a second. I'll go and try it again. Here we go. So there we go. Share. Okay. I've got a message here saying screen sharing is paused. I'll stop share. We'll have another go. Yeah.
Maybe you can send the presentation to me and I can share it for you.
Yeah, I sent it to you earlier today. Will you have that in your inbox?
Sorry, I haven't checked the box today.
Yeah, don't worry. I sent it mid-morning-ish, I think.
Sorry, I don't think I have received.
Okay, if not, I'll try and share it one more time. If not, I'll send it through to you and I'll come back. Bear with me 1 second. Okay, right. No, that doesn't seem to be working, does it? What I'll do, I'll stop my share. I'll come out and email it to you and I'll then come back in. It'll only take 2 minutes, okay?
Sure. Sorry for everyone to kept waiting for this. Maybe we shall play some videos to reduce this kind of awkward. Not sure about this. I'm going to play this.
Another prediction is around data science. And post-COVID in a virtual world has become just one of the key buzzwords, where data science and using data and AI and algorithms and machine learning to help portfolio companies becoming very, very prevalent. And so I think at some point over the next 5 years, you'll begin to see the data used absolutely instead of humans. And so we'll see whether that plays out. Very interesting for all of us in the asset management industry.
And what's happened in the last 10 to 11 months is many other industries have proven that they can do it too in a way that's different to the tradition of the 9 to 5 office hours. So that obligation of being present physically is now an obligation of delivering outcomes. And that is a very meaningful shift in how we think the workplace composition and culture. My advice so in this sort of job, you have to come to potential employers with specificity that helps them understand why they should hire you. Generalities don't work.
The move to the cloud, a massive trend, and everything is going into the cloud. Data infrastructure we see as the next gold rush. Data has become the most valuable currency in the world. AI is growing very fast. 3 years ago, it was still something of a new concept. It's now fundamental, and you're seeing machine learning being.
Let me share the screen.
Hi.
Right, try again. it's struggling again. It's not letting me share the screen. Let me, I'll leave again and I'll try and email it to you, Guy. 1 minute.
I'll try to make you the host. Can you like maybe?
Yeah, that might
try
be
now.
right. Yeah, let's try that. No.
No, I don't think it's working.
No, it's not. I've got a screen sharing paused here. What a shame. Let me try again. I will stop share. I think what might be easiest from my side, I'll just leave the meeting and go back through Zoom. This sometimes happens. Bear with me a second.
You have to make me the host again, otherwise you'll stop the whole meeting.
Sorry. Okay. Security.
It's in participant.
Is that right?
No, not it.
Okay, let's try again. Security.
Yeah.
Is that okay?
Oh, I can reclaim host. Yeah, I'm the host now. Yeah.
You're the host now. Okay, I'm going to go out and come back in. Thank you.
I'm sorry if this kept you guys waiting. Because it's the last session, so yeah, things sometimes goes wrong, and sorry about this. But we will last 1 hour in 4, and I don't think we'll end early. We'll just wait for him to come and stop the video. I just received his presentation, so I think we can start. Spare me with a second.
There we go. I've sent it.
Yeah, I
Well
have.
done. Thanks, Guy. Yeah, we just had a problem at our emails this end. So that's fine. Yeah, thankfully you've got that. Apologies, everyone. Bit of a glitch at our end. Anyway, so am I okay to speak, Guy, and you just move the slides for us?
Okay, sure.
Yeah. So here, well, first of all, thanks everyone for attending and being patient during that glitch. We've got some slides here to talk through on the sustainable investing in the post-COVID world. I've just split it into three key sections. One on markets, the impact and the subsequent reaction to COVID. Then an introduction to sustainable investing, which is a very important means of investing currently and likely to remain so for some considerable time, I suspect, and what is actually making it attractive now. So if we could go on to the next slide, Kai, if that's all right. There we go. So this is really just a slide I put together, which is a snapshot of global markets at the end of Q1 2020, which is the table on the left-hand side, and then the table on the right-hand side is those key indices at the end of the year. So, and just in case people aren't overly familiar with these indices, the top one, USTs, is US Treasuries. Then we have Barclays Global Aggregate is a bond index. Then we have various equity indices from Europe, the UK. The difference between MSCI All Country World and MSCI World is MSCI World is developed markets, and MSCI Country World is developed markets together with emerging markets. The topics is Japan, and then gold, obviously, is gold as safe haven asset. So what you'll see as the COVID pandemic began to take hold in Q1 last year, the reactions of riskier assets, i.e. equities, was quite dramatic. Now, these numbers are at the end of Q1, so 31st of March, and that actually wasn't the low. We saw lows a few days before there, but you can see some considerable decline in equity markets, whereas in US Treasuries, a traditional safe haven, you can see a 10% return through that quarter, and then gold, again, a traditional safe haven asset, of 3.95%. So you had some safe haven assets working as you would want in a discretionary portfolio or a multi-asset portfolio, but where the bulk of people would have been invested, i.e. equities, we had a pretty rough time. Now, fast forward to the end of 2020, which is the table on the right-hand side. Q4 we don't have to look at, which is the final column, but year to date is actually the performance of those indices through the entire calendar year of 2020. And you can see US Treasuries didn't really move much. They provided some shelter during Q1 and then, just traded sideways more or less thereafter. Bonds in the form of Barclays Global Aggregate, and this would be credit and investment grade debt, recovered sharply. And then look, with the exception of the FTSE 100, which had its own Brexit issues to deal with and currency issues, the rest of the risky markets or risky assets performed very, very well. An extraordinary return, in fact, given the lows which we saw in at the beginning or the end of Q2. So why was that? Why did we get such an incredible return from risky assets post the onset of the pandemic? And the next few slides really go some way to explain that. So if we think of the panic that was ensuing in Q1, then the central banks and obviously major governments around the world instigated a coordinated response. Now, this is the balance sheet of the Federal Reserve, the US Federal Reserve, the most important, or currently the biggest central bank in the world. Very important alongside the People's Bank of China and the European Central Bank. But what's marked about this chart is not only the incredible reaction, which you can see if you move the cursor to the left, to the right there, Kai, you can see 2020, the incredible ballooning in the Fed balance sheet. But trace it all the way back to 2008, you'll see on the x-axis there a huge jump in at the time, which was considered a huge jump in the Fed balance sheet as liquidity was poured into markets to support them. And that was the global financial crisis, which at the time, that response was unprecedented. There was great fears that would be hugely inflationary. What a reaction that was from the Fed. Then, as you can see, during the course of next 10 years, the Fed continued to have to provide support to global markets in the form of liquidity and ensuring a bid on US Treasury debt. But then look what happened in 2020, a truly extraordinary response by the Federal Reserve. First of all, to stabilize markets, because at one point we had US Treasuries, gapping out insofar as you couldn't trade them, which was a sign of, markets becoming dysfunctional. And thereafter, providing that liquidity, providing that support, providing that, the support that you'd expect the major central bank to provide in a situation where, the US economies and economies around the world had basically come to a standstill. So that was the monetary response of central banks. If we go to the next slide, Kai, you'll see this is just a very quick chart of the fiscal response from governments around the world. So again, we don't have to spend too much time on this, but it's just an illustration. This is the amount of support as a percentage of GDP that various countries around the world provided to their economies to provide the support that was needed as basically economic activity came to a standstill for a period of time. Now, this support has taken the form of fiscal support by way of furlough or grants or various other. In the US, it's been checks directly to households to help them survive financially during these very difficult pandemic times. Other support has been in the form of loans and guarantees or equity support. Governments coming in and actually buying the equity of some companies or providing loans to some companies that needed that support. So we had monetary support, we had fiscal support, which created a very supportive environment. If you go into the next slide, Kai, this is really summed up in this slide, which is something that's produced by Goldman Sachs on a regular basis. It's called their Financial Conditions Index, and it's really a measure of how supportive is the financial, the pipes and the plumbing of the financial system. How supportive is it to capital markets? And you can see in 2020, and this goes back to 2007, there has never been a time when global or financial conditions, and this really is very much focused on the US, but it's replicated around the world. Never before have financial conditions been so supportive and continue to be so supportive. The economies have been on life support, and the components of the global of this financial conditions index would be looking at the availability of credit, the movement in exchange rates, where interest rates are, et cetera, et cetera. So it brings all those different variables into one index, and it's obviously as it rises, it means that financial conditions are getting increasingly restrictive, and as it falls, it is financial conditions getting increasingly supportive. So here we are, very supportive environment. So what does that meant for investors in this post-COVID, or in the midst of COVID, and now as we're hopefully seeing the end of COVID on the horizon? So if you go to slide 7, Kai, this is actually something that was produced again by Goldman Sachs in May of last year, but it's quite illustrative even today, showing the absolute winners and the absolute losers of the COVID world. So as we all know, those who were working obviously started working from home. Those that were studying, such as a lot of you, were having to rely on online tuition, I'm sure. None of us were traveling, so therefore, airline industries had a very difficult time, catering, leisure, hotels. As we know, all of that section of the economy, faced incredible, basically stopped. These parts of the economy stopped. Whereas on the other side, we saw some great winners. How many of us are now tuning into Netflix or Disney Plus or Amazon Prime to watch our TV, using Amazon for our e-commerce, home fitness apps? How many of us, I think the best-selling, I was reading something about Adidas a few weeks ago, where their best-selling product online were yoga mats over the last 12 months. So, people's way of life completely changed and turned around. But as a consequence of that, some sectors of the global economy, and therefore, the equities and debt of those companies, performed exceptionally well, particularly when we're in this super boosted environment of the availability of credit and very supportive interest rates, whereas other sides of the economy, irrespective of all that support, could not be functioning properly until the COVID issue or the pandemic becomes increasingly under control. So I thought those were quite, just background slides, which I imagine won't be new to you, but it sets the scene as to what happened. And how markets reacted. But the next few slides are not really just focused on markets. If we go to the next slide, Kai, we have, just symbolically, yes, markets had an impact and markets had a reaction, but we had an incredible reaction at the society level. Going back to that point we've made earlier, those individuals or institutions that were investing in financial markets around the world, on the whole, have performed, or their capital, their wealth has increased substantially. For those not lucky enough to be invested in financial markets and relying entirely on income from the job that they had, for those that have moved in, gone on to furlough, obviously those incomes have been significantly reduced. And for those unfortunately made redundant, then of course real financial hardship is being suffered. And what we don't know quite yet is when the furlough schemes and the various supportive packages roll off, just how high unemployment might become. I know in the US, the Fed, the central bank there, is estimating unemployment, whilst official figures are saying 5 or 6%, it could be that unemployment is as high as 10% in the US as some of these supportive schemes begin to roll over. So society has gone through started to go through a real change as a consequence of the financial hardships. But also, if you then go on to the next slide, Kai, for us, you'll know that there have been some quite significant tremors through society in relation to inequalities, and these are the scenes outside the US Capitol during the Black Lives Matter demonstrations. Obviously, we've seen subsequent demonstrations not long ago, and a real inward-looking period for societies, particularly in Western societies, where the pandemic has had the greatest effect, or the most significant effect, as to consumption was driving everything. The idea that we all had to own things. I think what's happened for a lot of people now, they've reflected during lockdown and some of the civil liberties that have been restricted, how they want to live their lives once these restrictions emerge. And we might see there's certainly signs that we'll see a society that may be less driven by finance and possessions, and a more caring and supportive society. Perhaps more growth in philanthropy or the welfare state. We'll have to see, because of course the welfare state will cost money, and there's not a lot of money around in governments that have been spending all this money supporting the economy. But that's a presentation for another time. But this ripple through society, particularly in the US, was very, very interesting. If you then move on to the next slide, if you could, Kai, and this will be for the academics among you, which of course you are. If you've ever, and you're interested in finance and demographics and financial history, this is a great book to read. It's called The Fourth Turning, written by William Strauss and Neil Howe. This was published in 1997, and it's based on the premise that every 80 years in the US history, there's been seismic shifts in society, going back to 1776 when the revolution took place, through to the 1860s when the Civil War took place, through to the 1920s and 30s, and really into the Second World War when they had the Great Depression, and then obviously the country emerged from the Second World War, all the way through to 2020s where we are now. So every 80 or so years through history, there has been seismic change in US society. And when this book was published in 1997, Strauss and Howe foresaw a global terrorist attack, a financial crisis, an epidemic that would require quarantines, and the emergence of a very divisive leader in the US, which would cause society to split and turn on itself. Now, of course, for these things to be written in 1997 and for a lot of those things to actually have materialized, an amazing book to read. And if you get chance, I would do that. But anyway, the culmination of what we've seen in markets, what we've seen in the way how the pandemic has spread, how that pandemic may have even been created, where we have, in markets, and how do we, how we live with animals, where our food is sourced, etc., has caused a lot of people and a lot of societies and a lot of corporations and a lot of governments to say, right, I think it's time for us to have a rethink. And the next slide really is just a symbol of that, Kai. As societies have, or governments really have started now to put in place, what is the world post-COVID going to look like? What is the economy? What our economy is going to look like? Has globalization, which has caused immense prosperity or rise in prosperity around the world, the relief of poverty, etc., in many countries, are we now going to see a reversal of that globalization, meaning the economic pie begins to shrink rather than expand? And what does that mean for us all? What can institutions around the world do to remedy that, if that is what's on our horizon? So again, if you go into the next slide, Kai, I think that from an academic viewpoint, this is something to ponder. If you see the next slide, those of you studying economics or might be interested in this idea of stakeholder capitalism. Very famously, in 1970, Milton Friedman, the question was posed: what does the corporate say? What's the role of the corporate in society? And he came up with the idea that the business of business is business. So in other words, a business is there to make profit. That profit is distributed to its shareholders. It is, some tax is paid on that, and then governments can do with that tax how they want to deal with that revenue in terms of building hospitals and schools and whatever that may be. And that really is what's driven capitalism since then. The creation of shareholder value has been what CEOs in the US and around the world have been focused on for a long time, and that's how their entire compensation package is evaluated, is increasing shareholder value. Now, there was a groundswell of opinion leading up to the pandemic that actually the business of business is not the way that the corporate sector should be running itself, and the concept of stakeholder capitalism, where every company that operates anywhere in the world must have a societal license to operate. It must be fulfilling a societal need. And the key stakeholders in that business are not just the shareholders. They're also their employees. They're also their clients. They're also the communities in which they operate. They're also the environment within which they operate. So that concept is really, really starting to take hold. And how can we tell that? Well, if you go on to the next slide, Kai, just an example of this through the pandemic. I'm sure all of you will be aware of the stories where, a lot of companies, came answering to the call that governments made in terms of support. So we've got Louis Vuitton, Moet Hennessy on the side there, very, very famous luxury brand, stopped in some of its factories around the world making various perfumes and soaps, and converted the manufacture or the manufacturing processes in their factories to hand sanitizer. So there was a company that, you know, symbolizes wealth and luxury, and it turned itself around in terms of production to provide sanitizer to help with the treatment of or the prevention of the spread of COVID-19. On the other side of that page there, we've got Mulberry, again, another famous luxury brand that stopped making its luxury trench coats, etc., and converted factories and warehouses to be making PPE, and made 8,000 gowns for the NHS. So a real demonstration here of how the corporate sector was not, you know, the mantra of the business of business is business did not hold true here. We had very clear indication of companies recognizing the role they have to play in society. And that's just two examples. There are many, many examples around the world where companies focused on their communities. And really, the next slide, which some of you who've been following sustainable investing or stake, you know, the role that the corporate sector plays in society today, may have come across these UN Sustainable Development Goals. And, you know, this has been, there was the UN commissioned a report in 1987 called the Brundtland Report. And in that report, and it was talking about how emerging economies should develop, the concept of sustainable development was introduced in that report. And then over a series of UN held events, you know, there's been a number of events through the years, the Rio Summit, the Kyoto Summit, various summits where the UN or members of the UN have got together and really started to think about how prosperity can be spread more evenly around the world. And in 2015, the UN came up with these 17 goals, which really have galvanized government thinking. They've galvanized the way corporates operate today, particularly some of the, you know, they're all very, very important, but a lot of the issues around good health and well-being have really come to the fore as a consequence of the COVID pandemic. What can a business do for good health and well-being? What can individuals do for their good health and well-being? What can governments do to ensure their populations are focused on good health and well-being? All of these goals here are now representing themes which a lot of capital, be that private capital or public capital, is starting to finance. And what we've seen, if you're sustainable investors or wanting to invest sustainably, is more and more companies targeting their resources to action or to contribute to the attainment of these goals. Now, these goals are targeted to be achieved in 2030. So the clock is ticking. And, you know, these are now the blueprint through which, if you read the reports and accounts of a lot of companies now produced on an annual basis, there'll be sections as to where companies are contributing to these goals. So that hopefully gives the background to sustainable investing. I was then going to, if you go on to the next slide, Kai, it's just how sustainable investing has evolved over time. So 1970s, when it was quite rare for capital to be committed to this type of space, there was this exclusions culture. So if somebody or an institution or an individual or a trust wanted to invest sustainably, or say a university with its endowments wanted to invest sustainably, the only solutions really it could look at were portfolios where allocations or investments in tobacco or armaments or adult entertainment, those kind of sectors were taken out, and the resultant universe of available investments was the portfolio that was invested in. Now, over time, the sophistication of that has grown. There's been the concept of ESG, environmental, societal, and governance-driven investing, which is really, which has been a big step forward. And that's really where a lot of money is invested in the European space, where investors in Europe who want to invest in this space will commit to portfolios which are screened on an ESG basis. Where we have, and when I say we, this is Affinity Private Wealth, where I'm a director, where when we started to think about sustainable investing a few years ago for clients, we thought, this is the spectrum of green, really. Where do you want to put your flag in the sand in terms of aligning wealth to values? And we very much decided that we wanted to be on the right-hand side of that chart, or that timeline there. So when we're investing capital for clients, we focus on investing in companies whose products and services are in some way contributing to one or more of those 17 development goals on the previous page. But it is very complicated, and anyone who scratches the surface into sustainable investing will find some complications and some compromises they have to make. And these next two slides are just very quickly to demonstrate that. So we'll have a number of investors that will come into our office and say, I want to invest sustainably. I'm very convinced by electric vehicles and the whole electrification of the world. I want to be committing my capital to that space. So we then sit down with them, and clearly there's a lot of capital being allocated to that arena, and we'll talk about that a little bit later on. But we just sit down with the investor and say, look, that is all well and good, but let's just talk you through an example. If you're investing in electric vehicles, then you'll be investing in battery technology. If you're investing in battery technology, then you'll be investing in the mining of those metals that make up battery chemistry. Now, one of the key components of batteries is cobalt. 60 to 70% of the cobalt mined in the world comes from the Democratic Republic of Congo. And in the Democratic Republic of Congo, there is a lot of child labor. Now, of course, if you're wanting to invest sustainably, the idea that you would be contributing to child labor would be an anathema. So now we talk that through by saying, well, there's a lot of companies now. Tesla would be an example where they've set up they give back into countries like the Democratic Republic of Congo, and are helping to build schools so that children don't have to work in mines. They can go to school, be educated, and do other jobs or careers. So there is work being done on this, but if you're investing today, people have to be aware that further down the chain, there are consequences of investing sustainably, and it's balancing the positive impact with the negative impact to get to the position that you want to be in. The second problem of sustainable investing is the next slide, which is how on earth do you measure impact? And again, I won't go into a great deal of detail on this slide, but there's a lot of focus on carbon emissions or greenhouse gas emissions, as you can imagine. Emissions can be categorized into scope 1, scope 2, and scope 3. A lot of companies at the moment are reporting their scope 1 and scope 2 emissions, but a lot of companies aren't reporting their scope 3 emissions. So therefore, when you're hearing about what emissions are being made or what emissions are being avoided, are these companies actually including emissions around scope 3? And scope 3 will include, if you've made a product, what are the emissions involved in actually the end of life of that product? How is it disposed of? How is it dismantled? What are the emissions involved in that? And there is a lot of estimation around scope 3 emissions. Therefore, people who are wanting to invest and want a portfolio that is reducing carbon emissions by X, we have to explain to investors, okay, it's great to have that target, and I think we'll get there in due course. However, we're at this point here, and the journey to get to X is going to involve more legislation, more accurate recording of emissions. If we then just go on to the next slide, Kai, investing sustainably, obviously it's a point of wanting to generate investment returns, but also generating a positive impact. That point about emissions is important, but there's lots of other different impacts you want to be addressing. So do you want to be contributing towards education or providing access to education in developing areas of the world? Do you want to be addressing issues around inequality and diversity and inclusion? All these things are metrics within the sustainable investing world, which impact is being generated, but the metrics around properly measuring and demonstrating impact are still in their infancy. And no, I wouldn't say unreliable, but there's this issue that some of you might have heard of called greenwashing, where if these metrics aren't available, then they're perhaps estimated. If they're not estimated, it's a best guess. If it's not a best guess, then it's made up, and that's a real danger. So just in the interest of time, because I know we're just gone 1:45, I'll skip through. We perhaps move on to slide 20, if that's okay, Kai. Why is it a good time to be investing now? Well, there's a huge amount of we talked earlier about the government's fiscal stimulus and real support for economic growth or recovery out of the COVID pandemic. All of this, or a lot of this, is being channeled into green initiatives or sustainable initiatives. So there's a wall of capital coming the way for sustainable investors. Now, what are some of the examples of this? Well, UN Global Climate Change Conference is taking place in Glasgow in November 2021. It should have taken place in 2020. The important thing here is this is the first major climate change conference since the Paris conference, where the Paris Accord was struck and targets for reducing emissions were set. This is going to be the next UN-driven conference that actually measures progress, reports progress, and establishes policy that can address an acceleration of what progress needs to be made to meet the 2% or 2 degree, I should say, warming target. So watch this space. And the reason why that's interesting is not only the legislation and policy that's going to come out of that, but it's taking place in the UK. The UK is going to be center stage on the global, from a global perspective on how climate issues can be addressed. So we'll have a real, when I say we, residents of the UK, will have a real close eye view on this, and expect this to be in the press increasingly as we lead up to November. The other reason why sustainable investing right now is good is the Green Deal. So if you go into the next slide, Kai, the European Union in its recovery packages has said we're going to focus everything on green recovery. So whether that's electrification of the entire transport network, whether that is generation of power, whether that is insulation around new properties being built, etc., etc. A lot of stimulus is going into the green story. So again, if you're an investor, you're going to be investing in companies that are going to be getting this financial support, or markets being created through this financial support from government. Then the next 3 slides tell a little bit of a story, I think. So we all know who left. If you go to slide 22, Kai, we all know who left the White House in January. Kicked up a bit of a fuss, as we know, but Trump was very, very supportive of the fossil fuel industry in the US at the expense of climate change, or the sustainable space. You know famously that he withdrew the US from the Paris Accord and the targets set in Paris. Well, he's now gone, and look who has replaced him. If you go into the next slide, Kai, we've got Biden's slogan of "Build Back Better." The money, or the fiscal support that is coming through from Biden's rebuild, is incredibly focused on renewable technology and renewables in terms of power generation, transportation, conversion to electric, emissions being cut down. So where we had a US economy that was lagging, we might get to a point where a US economy is leading. And, that's a massive economy to be leading if it does get on the sustainable bandwagon, which of course it is. And bandwagon is a wrong word. The sustainable story, as we all strive to reach those 2% or 2 degree targets in terms of climate change. And then the most the election took place in November or the autumn of last year. The equally important announcement in autumn last year, if you go to the next slide, please, Kai, is China. China has announced, now China and the US are the two biggest emitters, greenhouse gas emitters in the world. China has committed to become net zero. So a net zero emitter, and this is something that will be talked about at the COP20 conference in Glasgow. The idea that more and more countries are committing to net zero emissions targets by 2040, 2050, 2060, from where those economies are now to where they need to get to, trillions of dollars need to be spent. So I keep using this phrase, a wall of cash is heading in the direction of renewables, of renewable technology, green technology, and that's a great opportunity for investors. But how big is the opportunity? If you go on to the next slide, please, Kai, the opportunity is massive. Now, this is just completely changing the subject. In 1980, AT&T, the American telephone company, had invented the cell phone and cellular telephony. They commissioned McKinsey in 1980, asking them to estimate how the number of cell phone users by the year 2000. They came up with a figure which was just under 1 million, I think. Now, of course, by the year 2000, the cell phone market, and this is just in the US, the cell phone market in the US was something like 110 million. So completely wrong. Now, this is no criticism of McKinsey, of course, because when technologies come along, as we're seeing now, the exponential take-up is extraordinarily difficult to envisage. But the reason I put that on is that some of these technologies that are taking place now, or the advancement that is taking place in climate and sustainability and agriculture, could be massive. And indeed, there's already signs that it's massive. So therefore, as an investor, time to be thinking about this space. If you go on to the next slide there, Kai, and we're getting close to the end of these slides, it's just really, again, trying to give you some illustrations of what this means. Electricity demand, 7 trillion in euros. This is just in Europe, 7 trillion euros of spending required to reach net zero emissions by 2050. European utilities could have an earnings per share compound annual growth rate of 7%. These are incredibly attractive returns in an environment where, returns are quite tough to come by, particularly as some of the stimulus starts to come away from monetary and fiscal. So if we then go down to the next slide, Kai, this is just, actually, we won't go to 27. If you go to 28, and this is really just talking about energy transition. So this is just, don't bother too much about the details. It's just demonstrating that renewable energy is now the cheapest form of electricity or power generation in 2/3 of the world. So it's now, and this is without subsidies in a lot of these places now. So this is a sector that is standing on its own 2 feet, but it's not just about power generation. If you go on to the next slide there, Kai, energy transition, if we think about the take-up of electric vehicles, it is estimated, based on the estimates of electric vehicles that the average family may have, the forecast is that the amount of additional electricity that house will need, or those cars will need in terms of charging, etc., is the equivalent of an average 3-bedroomed house. So just imagine just simply how much more electricity has to be generated, and all that electricity that is generated has to then be go through transformers, be stored, reach households, get to charging points, whether that be in the front of houses or along motorways. So the amount of electricity generated is just massive. The infrastructure associated with that is just massive. The amount of battery technology or batteries that have to be produced on an industrial scale is massive. So this is why we're seeing, these companies in around the world who are producing graphite today. And graphite is a very important component of anodes in lithium batteries. Some of these companies are, 10 times higher. Their share prices are 10 times higher than they were 12 months ago, 9 months ago, even, on the back of the realization that the whole rebuild of the global economy in many parts of the world post-COVID is going to be very linked to energy transition. But energy transition is just one component of that sustainable space. If you go back, if you think about those 17 sustainable development goals, there's going to be a lot of capital going into a lot of different sectors. If you then just carry on down in the interest of time, Kai, I know we've done, don't worry about slide 30, don't worry about slide 31 as such. And then why now? Yeah, I was just going to finish up with this last slide. Actually, you could stay on that previous mining slide if you wanted to, Kai. Just very quickly, it goes back to this sustainability question. Yes, if we're going to build lots of batteries, we need cobalt, we need graphite, we need lithium, we need nickel. But digging great big holes in the ground is not very sustainable in terms of pollution and energy that's required. This is a picture from a firm where they're trying to, all these big yellow trucks, the big trucks and machinery that are used in mines going forward will be electric. A lot of that electric being, particularly in Canada, which I think this picture is taken in, a lot of the power generation to charge those batteries is hydroelectric. The emissions from that are zero. So there's a lot of thought and process and time going into how the whole sustainable value chain meets the emissions and sustainable targets that are being set. And just to give you an example, this last page, and I'm not trying to talk about Affinity as a home for people's investments, it's just an illustration for you. If you go to slide 32, Kai, this is our this is the performance of our sustainable investment strategy post the low in March 2020 that we talked about in our very first slides. You can see that incredible rate of return. And that incredible rate of return is a consequence of investor capital, the cost of capital coming down for those businesses that are being sustainable, the cost of capital going up for those businesses that are not sustainable, and really investor return or returns to investors, the appetite to be supporting sustainability is massive and will continue to grow, we suspect. So the very last slide is really just trying to be a summation of what I've talked about. We firmly believe that, well, there's probably two things in capital markets going forward, which we think is important for anyone moving into finance as a career going forward. The two costs that are going to be very impactful is the cost of capital. Now, the cost of capital has always been clearly an important cost, but for those companies that aren't sustainable, their cost of capital will be going up, and you can see that already in some of the oil and gas companies, or those big emitting companies, finding it very hard to raise capital today. For those that are sustainable, their cost of capital is coming down, and therefore, if cost of capital is coming down, borrowing costs are coming down, therefore earnings and profitability should go up. So therefore, the return on that capital is more attractive. And then the other cost, we think, and this story is really only just evolving, is the cost of carbon. And I think what we'll see coming out of the COP conference in November is a real focus on the cost of carbon and how carbon markets can be made more efficient, how they can be more reflective as what the true cost of carbon is to our planet. And if that gets more realistically priced, then again, those companies that are giant emitters will find their cost of those emissions will become extremely prohibitive, to the point they'll either have to go out of business or they'll have to invest in technologies or new processes that mean their emissions will be reduced. And again, for investors, that will create very attractive opportunities. So I've rushed through those last slides. I'm very mindful that it's 6 o'clock. Kai, thanks very much for your patience there and running through the slides for me. I'm sorry about the glitch we had at our side, but happy to take any questions, or if there's any questions that you might send through, I'm happy to reply to those over time. Over to you.
If you want to ask a question, you can just raise your hand and speak up, because we do have only a bit of people today, so it can be very interactive. How many questions can you take? I think 2 or...
Yeah, a couple of questions will be fine. Okay. If there are any, it doesn't matter if there aren't, or if if people want my email address or whatever, and they want to send anything in due course, happy to share that. Do you have my email address? I think, Kai, if people ask for that, that would be fine.
Hi, Russell.
Hi.
Thank you very much for that presentation. It was very informative. I was just wondering your thoughts on where you think in the renewable energies market, where the most growth is, whether it's sort of solar powered or hydroelectric or sort of wind power, or whether the growth is more in sort of the mining of, as you say, like cobalt and lithium and things like that. Yeah,
no, that's a very good question. I think, trying to choose those winners would be very difficult. I think all those sectors will have their time in the sun, if that's the right phrase, in terms of returns. What we're seeing very much at the moment is spectacular returns with anything linked to hydrogen, hydrogen power, green hydrogen, and green hydrogen being used to produce steel and this kind of thing. And actually the Green Deal that I mentioned earlier has specifically mentioned that it wants to support the growth of the hydrogen industry. But for us, the way we're thinking about investing, and we take ourselves back to the gold rush in California, in the 1860s or whenever it was. The people that made the money out of the gold rush, beside the odd few that found gold, it was the people that provided the picks and shovels to the miners that went out to try and make their fortune finding the gold. And actually focusing on the picks and shovels of the sustainable space, i.e., in the water industry, if you think about sustainable, water treatments, water pumps, those kind of thing. If we're looking at the actual energy transition space, then it's those companies that are making the cables. That we've got, the UK is the leading offshore wind power generating country in the world, but actually getting that power onshore, all the cabling that's involved in that, the components associated with that, the making of the actual turbines themselves. The value chain is vast, and there's lots of opportunity along that value chain. If I was to say what is really hot right now outside of hydrogen, then certainly battery technology. Everything around battery technology or components to batteries is attracting a lot of capital. But the way we approach investing is being very diversified across all that space to try and hedge our bets in what will be the ultimate winners.
Thank you.
Thank you. There is a question in the chat. What indicators do you use to assess the degree of implication of a company in sustainability?
Yeah, that's an excellent question. You see, I mentioned ESG earlier, so there is a lot of data providers around the world today, an increasing number, who are attending analyst presentations, etc., and focusing on environmental, societal, and governance issues. And they're providing then scores on those companies that they are assessing, and that information can be accessed through a database. A famous one would be Sustainalytics. Another one would be, I think, MSCI run their own ESG sources of data. Now, there's been some criticisms of these data sources because one data provider is providing very different information than another, and the correlation actually between these data sources for the same company are very different. So going back to that point we said earlier, the measurement and metrics around what is a sustainable company or what is a sustainable factor that should be measured is causing a great deal of debate. And the European Union is leading on this, as it has been on sustainable finance for a number of years now. And it is just in the throes of introducing a piece of legislation called the Sustainable Finance Disclosure Regulation. And it's defining certain metrics which a company has to report on uniformly. So all companies across all sectors and all regions and all geographies. And you've then got some comparable metrics which enable an investor to compare company A with company B. Now, for the investment management industry, that's a real step forward, because we now feel that there is light at the end of the tunnel for us to be able to properly quantify and measure which are the most sustainable companies. Now, the focus at the moment is very much on environment and environmental issues, but we're hoping over time it will include diversity, it will, inclusivity, equality issues. The whole sustainability space is much more than just carbon emissions. There's many, many more things that make up this story. But the focus of metrics is currently going to be on carbon emissions, but a uniform taxonomy or a universal taxonomy is tantalizingly close. So hopefully that answers that question.
Thanks, guys. I think we can end the session here. And this marks the end of the Leeds Finance Summit this year. And
I have just a question.
Oh, okay.
Please.
Mm-hmm.
Thank you very much for your answer. Actually, I was the one who asked the question about the metrics.
Yes.
Actually, I'm conducting a research for these metrics, but in the consumption field. I am a student in Morocco. It's in North Africa.
Yeah.
And
Okay.
I'm doing a research projects with the UN about these metrics in the consumption base. I would be very glad if you can just provide any references that can help me in this project, please.
Yes. So is what in terms of the evolution of this space and what's happening? Well, as a starting point, that Sustainable Finance Disclosure Regulation is the EU legislation around that is a good starting point, I think. The task force on climate financial disclosures, the methodology and thinking around that is something that you should look at. That's the TCFD. There is if you look at the Accounting Standards Board, there's an institution called the Sustainable Accounting Standards Board, so the SASB, and they've drawn up a series of metrics, and they've specified them on a sector level that can help measure sustainability, be it consumer related, be it employee related, be it health and well-being related, all these kind of things. That might be 3 places for you to start.
Thanks for Russell to share your thoughts with us. It's been a pleasure today. And thank you guys all for attending today's session.
Thank you.
Any more questions, or we'll just end the meeting here? Okay, see you guys next year, maybe, I guess. Bye-bye.
Bye-bye, everyone.
We enjoyed
Thank
it
you.
too. Bye.
Bye-bye.